Hi everyone, and welcome to the Intelligent Investor Income Fund webinar. I'm Tom Wilson. I'm the education specialist at InvestSMART, and today we're going to be looking at the Intelligent Investor Income Fund based around the secondary offer that we've got running, and it runs until the 25th of August. Basically how this webinar works is that you can ask us questions live. We'll do our very best to answer them. There'll be times, of course, where there's that many questions that we can't get through them. But basically, we'll do our very best. They'll display on the screen, and I'll even try and answer some in the background. And always remember that we just provide general product advice only, not any type of personal financial advice. But enough from me. We're joined by Nathan Bell, who's the portfolio manager at Intelligent Investor. Thanks so much for joining us, Nathan.
Thanks, Tom. I should just let everybody know that we had a practice run yesterday and we're all excited about the new format of our presentation, and now we've got here this morning and I have no control over the slides, so people are going to hear me asking you to flick the slides forward. But hopefully the formatting at least looks good, and the questions being answered on the run hopefully will be an improvement as well.
Yeah, excellent. Unfortunately, if you can't do that, Nathan can't flick through by hovering over, I'll have to be your lackey and do it for you. Just for everyone out there, you get a copy of the slides as well. We're going to go an alternative slide deck, but there was problems with the formatting. We thought much better that you have a nice looking set of slides for me to talk to rather than me having any control this morning. So let's get into it. Excellent.
So it's been tumultuous is probably too much of a word for the fund, but today I want to talk a little bit about the changes we made in early 2019 in response to a really poor period of performance, and how those changes have driven the performance of the fund. And so that's one really important point I want to talk about. I also want to really drive home today the importance of growing dividends rather than just buying stocks with the highest yield. It's still the biggest mistake I think that income investors make. But before I do any of that, I want to talk about what we're actually trying to achieve with this income fund and how I believe that you should go about income investing. And maybe not everybody agrees, but if you want to outperform the market and you want a high dividend yield, then this is really the only way I know how to do it. And it's been born out of 20 years of experience at Intelligent Investor, where if you include the model portfolio that we used to run before we started managing real money, this fund has done about 2% a year better than the index, and I don't know any other income fund that's done that. So I want to talk about what it is we're actually trying to achieve, why it's so difficult, and why so few income funds underperform, which is probably not a surprise to people given most funds, actively managed funds, don't outperform anyway, let alone an income fund. But sometimes I think you just need to go back and realize, simplistically what it is we're trying to achieve and why it's so important. So it's going to skip across a couple of slides, and if you can just go across for me, Tom.
Sure.
Next one. Thank you. So the slides before that, you'll have a copy of the slides, you can go through that, but they're not particularly important for today's presentation. So I've titled this presentation, What is Income Investing Nirvana? So for me, it's outperforming the market by 1 to 2% per year, which is what we've done. And we also want a higher yield than market if possible. But most importantly, we want a yield from the fund that is going to grow much faster than the market. Because if you can't do that, then you may as well buy an index fund. And it's actually quite hard to do, which is why most income funds focus on maximizing the yield rather than outperforming the index. So there are all these income funds out there where you pay high fees and you're paying for active management, but you're actually guaranteed to underperform, but there might be something in it that people are more than happy with, like maximizing the franking, for example. And they're easy to spot because usually there's an inferior benchmark, like some of these funds just use they include franking credits, for example, and don't include the franking credits in the benchmark, which makes it easier to beat. Or they may just focus on the level of franking, or perhaps measure it against the RBA cash rate or something like that. So, if that's what you're after, if you're happy to underperform the index, but you want an absolute maximum yield and maximum franking credits, then this isn't the fund for you. But I just really think that that's just a really inferior way to invest, when you can just buy the index for a start without paying any of those fees, and you get a healthy yield anyway. And you get some pretty decent franking credits as well. But you don't have to accept that either. You can actually do better. So if we just go to the next slide, Tom.
Sure.
This is a very, very simple chart. This is really compound interest at its most basic. And it's really important, because if you just give up 1 or 2%, or maybe even 3 or 4%, depending on what sort of income fund you invest in, if you're giving that up per year, it may not matter too much to you over short periods. But if you're giving up even just 1% or 2%, and it's usually more than that in most of these funds, if you're giving that up, then over 10 and 20 years, it makes an incredible difference. So you can see there, this is just a random number of a $100,000 portfolio. And if you earn a 9 or 10 or 11% per annum, now getting 11% per annum for an income fund is pretty hard, but if you're throwing franking credits, then it's a lot easier. So it is somewhat realistic, and a lot of these funds certainly wouldn't be doing 9% per annum either, but I certainly think we can do 1 to 2% better than the index. We've done that since day dot. We're doing it now, and as I'll talk about, if you took out the 2-month period in early 2019, we'd be actually more like 3, which I certainly wouldn't think we can continue to do. But you can just see here that the difference in the size of the portfolio at the end is monstrous. After 20 years, if you earn 9%, you're at a sort of about $550,000 portfolio from 100,000, which is still great. But if you earn those extra couple of percentage points over that period, it's an $800,000 portfolio. So it's not quite double, but it's that sort of magnitude. So this is what I talk about when you're getting back to basics. This is why we fight so hard for that extra 1 to 2% over the index, because over short periods it might not matter too much, but over long periods it's absolutely everything. If we just go to the next slide, Tom.
Sure.
And it's amazing. I was sitting here just thinking to myself not long ago. So we had a sort of a bit of underperformance about, I don't know, 9 months ago or 6 months ago, whenever it was. And I was just looking at the outperformance of the fund and just thinking about how many thousands of decisions we make to get that extra 1 or 2% of performance. And you say, geez, is it really worth it? You can just buy an index fund and have no stress and not make any decisions. But you go back to those very basics. And if you can do 2% better than the index over a long period of time, that to me is income investing nirvana. And that's what we've been able to achieve over the, going way back to 2002. And that's what I believe we can do moving forward. Even though our current performance isn't quite there at the moment. But I'm going to come back to that in a moment. So what is it that we actually need to do as investors to make sure that we can get that extra 1 to 2% of our performance? And this is just more general stuff for anyone who's investing, whether you invest with us or someone else, or whether you're new to investing. These are really it's our process and what we're looking for. And the number one thing is you can't sacrifice your investing process to maximize the yield. So a yield is only sustainable if a business can grow its profits. And you can see in the second point there, I've got remember the rule of 10%. And it's a bit of a famous rule that says the closer a company's dividend gets to 10%, the yield, gets to 10%, then the more likely it is potentially going to zero. Because the market isn't stupid, right? So there's thousands of people like me sitting in the market watching all these companies. And if the long-term return of the market is around 9 or 10%, then people aren't going to be so stupid just to offer a 10% yield for nothing. So when you see those big fat yields, you've really got to ask yourself, what's driving that? Why is the market prepared to give me what seemingly looks like something that's too good to be true? And the reason is it usually is. There is clearly risks there that maybe you don't appreciate, but they're clearly there because the market's telling you that. So our process, whether we've got 4 different funds now, and the process across all of them is exactly the same. And then it's just a tilt at the end about, essentially just looking at your universe, about how you construct a portfolio that comes up with an appropriate yield. But you just can't get away from the fact that we're still looking for businesses with a competitive advantage, with a long-term focus, run with CEOs that preferably have their money invested in the business alongside yours. So whether that company pays dividends or not, we don't want to give up on that process. That's what we're searching for. And then within that, within that universe, we come up with a subgroup to tilt our funds one way or the other. So that's how we get our 1 to 2% is by our investment process that's worked for over 20 years now. And that doesn't mean our process is ingrained. We're always trying to improve. But the capital gains usually come to the companies that can grow their dividends. So in that sense, you can have your cake and eat it too. But you've got to get away from just looking at the big dividend yielders, the big mature dividend yielders on the market. And that's what most people, at least historically, haven't been prepared to do. But what I've noticed more recently, particularly the last 12 months, is that the banks have basically provided no capital gains in 20 years. I mean, NAB, I think it's been more like 25. So you've got your dividend yield and you've got your franking credits, and that's been okay. But it's a subpar result. And people are finally realising that they can't get the capital gains from the banks anymore. So you're not hearing people talk about the banks as great investments like they were even 3 years ago. And the other big risk, I think, too, in the market is, I'm going to talk about this later on, but the index at the moment is yielding about 4%, and about a quarter of those fully franked yields come from the iron ore miners alone. And if you look at the broker reports, they're basically forecasting a 50% fall in those dividends over the next couple of years. Now, I don't know if it's going to be that severe, but that 4% yield might actually only really be like 3.5% in a couple of years. And if we have a proper recession and the banks cut their dividends again as well, then that's another big reason the dividends might fall, because the iron ore miners make up about 20% of the index, but account for about 26 or 27% of the dividends. And the banks account for about 19, I think it's 19 or low 20s of the index, but they account for, I think it's 31% of the fully franked dividend yields of the index. So they're big portions of the index in terms of their market value, but in terms of dividends, it's nearly 60% between those two groups alone. And so that's that bottom point there I've put in there about trying to avoid yesterday's heroes. But you've got to keep an open mind as well, because if we do go into a recession and the banks are trading at values 30 or 40% cheaper than they are today, then all of a sudden they might become good investments, because then you will get the capital gains and the yield as well. But at the moment, the returns look really poor for them. They've been poor for a long time. So we've got to work harder to find other stocks that can grow their dividends and outperform those banks and those iron ore miners.
And I guess the point there too, Nathan, is that like this is a somewhat diversified ETF, isn't it? Like you're not just putting your money just into, say, a few miners, some banks and things like that. You've actually spread it across a number of different companies that you see potential.
Yeah, I think a lot of people think when they hear the word concentrated portfolio, which, there are worse names, but the sweet spot for me is around 25 stocks. I find once you get past that, you start to own a lot of small positions that aren't going to make any difference to the portfolio. You have low conviction in them. They're not very good ideas. And the research shows that it's one of the biggest reasons why most active fund managers underperform is not because they don't know how to pick stocks. And a big part of it is their big fees as well. But the other part of it is actually they're really good at picking their top 10 stock ideas. And in the market at any one time, there's never going to be a huge amount of bargains. You sort of pick them up here and there over time. And at different stages, there'll be lots. And then it's feast or famine sometimes in the market. But their top 10 stocks are actually good ideas. But the problem is they're forced to diversify. So most funds will probably own, income funds, I'm not sure, I'm just randomly picking out numbers, but maybe 60 or 70 stocks, for example. So they might have 10 really good ideas, but they might only make up 20% or 25% of the portfolio. And so they've got to diversify across all these really ordinary ideas. So by pure mathematics, it drags your returns down. So I find that 25 stocks is more than enough diversification. I think the statistics show that once you've got 7 or 8 stocks across different industries, that's about 90% of the diversification. But obviously not many people want to take, own 12, 7% positions or 8% positions and risk, one of them going broke. So I find the 25 stocks works really well for us. And if we get into a really, great market for us, a cheap market where there's a lot of pain and lots of ideas, then you really want to try and concentrate that portfolio into your 20 best ideas. But normally you find around 25 for us.
Yep.
Skip ahead, mate. So for people who follow these webinars each year, you already know the answers to this, but I want to go through this because for people that don't really understand how important the growth in dividends is, I find this is a slide where the penny drops. And it's not the actual numbers that are important here because there's a bit of cherry picking going on. I'll explain why in a minute, but it's the point, it's the underlying fundamentals of this idea that is what matters. Because if you can understand this and you really get it, then it can really change your approach to investing. So we've got two companies here, Company A, Company B. These are real world examples. I'll tell you the companies in a minute. So one of my best recommendations at Intelligent Investor over the years was a company back in January 2010, and you can see the price I recommended it. So this is our subscription business. I've been an Intelligent Investor about 3 years by this stage, 3.5 years, and we're just coming out of the GFC. And this company I really liked, but I remember thinking at the time, I thought if it got to $40 in the next year or two, that would be a good outcome. And when you hear the stock's name, you realise how undercooked the whole idea was. And the yield at the time was only 2.2%, so you can probably guess this is a growth company. And since then, the capital gains have been 17% per annum, so enormous returns. And the dividend growth hasn't been far behind at 13%. And the dividend today, based on that original purchase price, is 11%. So the point is that this is a growth stock that's actually become a fantastic yield dividend story. Now, Company B is your more typical yield stock that everyone will know. It's a household name. And the share price at the same time, back in 2010, was $56, and it was yielding 5.2%, which is pretty good. That's fully franked. So franking on top of that 5.2%. The capital gains since then, and it's been by far and away the best performer in its category, have only been 4.4% per annum. But, that's almost 10% plus some franking credits, so that's a par. And dividend growth, though, only 2.7% per annum. And the yield today on that original recommendation price, or the price at the time when we recommended Company A, is only 7.5%. So which stock would you rather own? Now, obviously, you would much rather own Company A, because if you own that in decent size, then that stock would have made you wealthy on its own. So what are the two stocks? Well, Company A is CSL, not a company we typically think of for dividend yield, and Company B is Commonwealth Bank. And yes, I've obviously cherry-picked with Company A. You could use other stocks that maybe haven't grown as fast as CSL or been as good, but at the same time, the other banks haven't done anywhere near as well as CBA either. So this is really the point I'm trying to make, is that the value in income investing comes from the growing dividends. That's what you need to find. And that's what's really been working well for us over the past 3 or 4 years. So if you can understand that, then that just puts you way out in front of most income investors who all they're really thinking about is maximising the dividend yield and the franking credits. But if you're a serious long-term investor and not just trying to maximise what's in your pocket this year, then Company A gives you the much better outcome. Skip ahead, mate. So now I want to talk about performance, which is what everyone wants to know about. So this chart here goes back to when we first launched the fund. This isn't the ASX listed fund. This is when we actually started managing money in 2015, which was just after I left the business for a few years to go and work on an international fund. And this essentially, we just launched the model portfolio, which I used to run for about 5 years before that, which always had a tremendous track record. And funnily enough, the income model portfolio always had a better return than our growth portfolio. And some of that was down to some different managers earlier in their life. But I always thought it was just because the income portfolio was just a really powerful idea in the Australian market, where you can actually get your capital gains and your high dividend yield as long as you have a value investing mindset to buy those companies when they're cheap. So what have we done since then? Well, we've outperformed by 1.1%, and I don't actually know any other income funds that have outperformed over that period. So it's in a fairly unique company. I'm sure there's some other ones, and if anyone's got them, please send them my way, because I'm always interested to know what stocks they've owned to do it or how they do it. And the key thing here, though, is there's a real big difference between, you can see in the 3 years and the 5 years. And if you go back to sort of 5 and 7 years, it incorporates the period early in 2019, which was a really poor period. And just for those who have been invested in the fund, it gives me a chance to thank you for hanging in there, because at one point the fund was 26% under the index, and it happened in a period of about 8 weeks at the start of 2019. So I rejoined the business in August 2018. It was always going to take a year to get across all the stocks again. So I was hoping for a nice calm period over the next 12 months till I settled back in. And then the market started falling in late 2018. And I thought, oh, actually, this is good, because I'm going to get some opportunities here and makes my life a bit easier. And then basically I come back to work on the 1st of January, and the market just took off. And it wasn't that, I always talk about, it was almost like a grenade going off in my face. It was like, welcome back to Intelligent Investor. And within about 8 weeks, the fund was 26% under the index. And it wasn't actually that we'd gone backwards. It was just that the fund hadn't moved, and the iron ore miners and all these growth stocks had taken off. But there were some absolute key lessons to be learnt from that period. And if you go across to the next slide, Tom.
Sure.
So after that period, we made an enormous amount of changes, because one, I was tired of getting emails from people telling me I had no idea what I was doing in the most certain terms. And I also had our CEO, Ron, was sending me another income fund that he was familiar with, telling me, why aren't our returns as good as this fund, and why don't you just copy them? And incidentally, I had no respect for that fund whatsoever. And within about, I think, 18, 24 months, that fund ended up actually getting taken over by another manager. They had to outsource the management. The returns were so poor. And it was because they were just trying to maximize the yield. And I was saying, look, that's not the way, but we need to make a number of changes here to the business, not just the fund, but the business, to get things humming. So what we did was, for anyone who's read Collins's book about getting the right people on the bus, that was the first thing. So we had to turn over some staff, and we had to get the culture right, and we had to get people back looking for their best ideas. We had to get the fund focused on stocks that could grow their dividends and not just maximize the yield. So we eliminated the banks. We put a cornerstone holding in BHP in the fund, which has served us well since then. So the BHP is about a 12% stake in our fund, which is similar to what it is in the index. So we're still underweight about 10% of the iron ore miners, but I'm getting too old to chase down 26% deficits. So I don't want to go through that again. So I'm happy to hedge the portfolio with at least being half weight in the iron ore miners, even if they aren't particularly cheap. The other thing we did was we found some higher quality small and mid-cap growth stocks. I don't think people appreciate that some of those small stocks actually pay good dividends, and they're the ones that I expect to drive our returns over the next 5 and 10 years. It's great to have a core of wonderful businesses that are mature and safe and all that sort of stuff, but if you really want to outperform, then we've got a small basket in our portfolio. Because all our funds are listed on the ASX, we have to abide by the ASX listing rules, and they're very, very tight on liquidity, because no one wants to be responsible for a fund in a downturn that can't return money to investors. So we can't own many. We can only really own 2 or 3 at most. So we really have to get those small cap stocks right. But the ones we own, I really like. I think they can become much, much bigger companies in the future, and they can pay much, much bigger dividends, and a couple of them are already paying big dividend yields anyway. So again, it's this idea that you don't have to give up on your capital gains to get a good dividend yield. You've got to have an investment process that works through all seasons and finds these good businesses that can grow, naturally, by focusing on what makes a good business, what's early in its life cycle, what sort of management talent does it have? Does it have a business model that can actually become a lot bigger, or is it going to max out pretty soon? And the other thing I've really liked is Gorad's call on the coal stocks in particular. Was we made a lot of money out of Whitehaven Coal in particular, which has really helped our sort of more recent performance. So we've still maintained our value investing instincts and our contrarian edge. But along with that, we go back to what's worked for us over the last 20 years has really been finding those great growth stocks that can grow their dividends over time. So the second point there, I'll just quickly go through. We had a really good period at the end of 21 when the market was coming to the end of its 13-year bull run, And we maintained our valuation discipline. We didn't do anything silly. We got some great takeover offers for our stocks, and we had cash at the right time. So in 22, when the market was falling and people were starting to panic, we did really well because our coal stocks did great, did way better than I could have imagined. And we had a bit of cash there. So that worked really well, but it hasn't really worked as well since then because the market's been on a tear, and we haven't done too badly, but the market's really been bidding up the price of the most familiar stocks, and particularly resources stocks, and they're not necessarily where we want to be for the future. The value isn't there for a start, and resources stocks tend to be inferior to a good quality industrial stock over time as well. The only real mistake we made was Star Entertainment. Was certainly a costly one. We drastically underestimated the size and price of the capital raising, and the company's still not out of the woods, but if it can get back to something what I think is a more normal valuation and there's a clear plan there of what it needs to do, then hopefully we'll get at least most of that money back, if not all of it. But that's really been the only big stock picking mistake. Domino's hasn't been great, but that's a far smaller loss, and that story's not over yet. So I'm actually really happy with the performance, because if you just look back at the last little while, okay, what have you done for me lately? Maybe not so much, but compared to early 2019 when we were 26 behind the index, and now we've got back about that 26% plus another 10 or 11%. I'm really happy, and for the first time since I've been back in the business, I finally feel like I'm back in a fair fight with the market with this fund. So again, thank you to everyone who stuck with us through that period, because I know it wasn't easy. The other thing I really like, just in comparing what you should expect from the index over the medium term versus where we're at with our fund, I really feel like the index has spent all of its bullets. The iron ore miners are really highly priced and certainly aren't pricing in the potential big increase in supply and fall in the iron ore price that virtually, you can say most people in the market are predicting, but that's not reflected in the price. So certainly not everybody is, but it's certainly become an increasing view, particularly the last couple of weeks, where people are starting to worry that the property collapse in China is going to become a global problem rather than just a Chinese problem. So if the iron ore miners, let's just say, for example, they did cut their dividends by half in a couple of years, if that supply all comes on, the iron ore price cracks, then that's about 10 or 12% cut in the yield of the index, which is currently yielding about 4%. So it'll take it down to about 3.5%. And at the moment, the yield on our fund is 4.5%. And if we were to invest, I think we've got about 9 or 10% cash at the moment. So if that got invested at the average yield of all the other stocks, essentially that would be 5%. A bit of growth next year, hopefully. Obviously, we own a big stake in BHP, so if its dividend was cut, that would obviously affect us as well. But we've also got a few stocks that haven't recovered their dividends since COVID, or for company-specific reasons at the moment, Star obviously being one of those. So if those three stocks can get back to their full dividend-paying capability, or at least what I think they are, then there's another 0.5%. So with a bit of luck over the next year or two, maybe where the index yield goes backwards, hopefully ours actually goes to an equivalent of like 5.5 or 6% from where we are today. Now I can't promise that, but that's just the difference of where I see the market is really highly valued, and the returns I expect from the market are quite poor. In fact, I'd say it's one of the worst times to be buying the index, over time. And the Aussie market has been one of the best performing markets, if not the best performing market over the last 100 years. But I don't expect investors to get much more than the dividend yield and your franking credits, and you'd be lucky to get any growth. And yet I don't see our fund as anything like that. There's a bunch of companies in our fund that have been absolutely belted. And I think once the confidence comes back to those businesses, there's lots of upside for those businesses. So again, usually the focus is all about yield, but if those dividends come back and the yield comes back as well, then we should be owning a fund that is earning a yield that's well above the market, growing much faster than the market in far better quality companies that are growing much faster and growing their dividends much faster. And hopefully that's how we'll get our 1 to 2% returns and beat the market. So it's pretty simple, but you do have to have the confidence to move away from what's popular in the market at the moment, and that's what nobody wants to do. You can see that in where everybody's pushing the money at the moment. The big push in the market over in the US recently and in Australia has all been done by personal investors. It hasn't been done by professionals. So it's been individuals really trying to, I think that this is very typical after you have sort of a big bust after a long bull market, is they try to reflate the previous bull market. And I think that's what's going on at the moment. So we've just stuck to our discipline and kept things simple. And that's what worked for us for 20 years, and it'll work for the next 20 as well. Next slide, Tom. So I basically covered all of this already, but I'll just go to that last point at the bottom. I don't know whether inflation is coming down, but I don't know where it's going to settle, and I don't know whether higher interest rates are going to be required to knock it down. It's easy to look at Australia, and I think the issues here are less pronounced, but if you go to the US, there is more talk of higher interest rates and more inflation. And whatever happens there, this tends to what happens to Australia, at least in terms of the stock market. But I just want to reiterate that in an inflationary environment, the companies that can grow their dividends are far, far more valuable than companies that can't. So you might have a good company that has a nice high fat yield, but if it can't grow that dividend yield in an inflationary environment, that's going to kill your wealth. So the whole idea of inflation is really important, but we have an investment process that already deals with that. It's the growth in dividends that we're looking for. I think I've probably said that enough times that people probably understand it by now.
Yeah.
Next slide, Tom.
Sure.
So how are we positioned at the moment? I'm not going to go into great detail on any of the stocks, but I thought I'd just talk about a few. There's been pretty minimal changes in the fund over the last, probably the last 3 years, really. I just like this quote from Warren Buffett. Beware the investment activity that produces applause. The great moves are usually greeted by yawns. To anyone who's been following Buffett recently, he's made some great returns in Japan and made some big money in Occidental, which is an oil company. So nothing too glitzy about those stock picks. And for us, we've really just added CSL, we've added back Lavisa. Can't remember whether we used to own Domino's or not, but added Domino's after the big share price fall. Mineral Resources is a new stock, relatively new stock for the portfolio, and pretty boring one. Added Wesfarmers, and Wesfarmers definitely fits into that. It's easy to put it in that category of expensive defensive, but we think there's some lithium assets in that business that are being undervalued, and it's been our experience with Mineral Resources that's led to Wesfarmers. So without the lithium business, I think probably 7 to 8% total return is all you should expect. But I think with the lithium business, there's potentially a 10% plus return, and I think that's pretty good for owning a pretty solid business when most of the revenue comes from Bunnings, which is certainly one of Australia's best businesses, if not the best. I just listed a few companies there. Frontier Digital at the end there, it's only a tiny position, but some of those bigger positions like Credit Corp, Pinnacle, Star I spoke about, Domino's, Lavisa, MA Financial, which is a small company I think can become a more Macquarie-like business over time, and RPM Global, which is one of our largest positions. Their share prices are well off their highs, but they're also stocks where I fully expect those companies to take out those highs again over time. Not Star Entertainment, but the others. Sorry, not Domino's as well. Certainly highs of the price that we paid, but no, I can't see Domino's going back to $160. And like I did in 2021, that was one of the most ridiculous valuations I've ever seen. So there's a huge amount of potential in the portfolio still, and so that's how we're going to get the capital gains to beat the index. We don't own any banks at the moment, but again, if they get cheap enough, then we'll be happy to own them. So in summary, I think this is the right time to be contrarian. It's the right time to be an active manager. We thought with this downturn, or it didn't actually last very long, but after 21, so 22, I thought by now we might have a few more stocks to add to the portfolio, but it hasn't happened. We haven't had this value investing nirvana that many people were predicting. I don't know whether that's going to come or not, but if it comes, then we'll make the most of it as we always do. And if it doesn't, then we'll just keep adding stocks as we go along, like we do all the other times. So I think the market returns, most importantly, if anyone's thinking they're going to get more than 7 or 8% max for buying an index fund, then I think you're kidding yourself. The days of 9 or 10% owning a portfolio of iron ore miners and banks are over. I think people understand that with the banks, but you're still reading stories that iron ore miners are the new banks. And as soon as I saw people sprouting that about a year or two ago, that just puts me on alert, because once you start getting those very simple sounding narratives in the market, usually the opposite happens. And I don't know what it is that finally knocks the iron ore miners off their perch. But that would, if the iron ore miners were to fall materially and cut their dividend, then that's a big source of outperformance for us. It's been a headwind for us for a while. Next slide, Tom. So distribution and yield. So I've already talked about these. The one thing I just at the bottom there that people would like me to talk about is what overlap is there between our 3 Australian funds. Are they buying the same stocks if they own INIF compared to IIGF? And I actually think it makes sense. I don't know whether people do this. I'm sure some people do this, but sometimes if you don't quite need the yield as much as what you might think or what the others do, then you can combine INIF and IIGF, so that's our growth and income fund, and sort of get the middle ground in yield. I don't know what the yield for the growth fund is at the moment. It's typically around 3%, excuse me, when the income fund is usually about 5%. So if for some reason you wanted 4% and you wanted a bit more growth and a bit more outperformance, then that's how you can combine them. In terms of the crossover, there's not a huge amount of crossover. In the ideal world, I would love those 2 funds to be exactly the same. You want high yielding stocks, lots of fully franked dividends, extremely cheap valuations, and lots of growth. So that's basically how I start my day, is looking for that for all our funds and working out how they could all be exactly the same, and they tick the boxes for all the ESG stuff as well. But obviously that's not the way the world works. So we have some similar funds, but the correlation between the two really comes down to a handful of stocks. We certainly don't have a core position in the growth fund of BHP, for example. And again, the yield's much lower. But we do RPM Global as a common stock. So we do have them, but I see them as 2 quite different funds, even though I'd love them to be exactly the same. And I think that's just about it, Tom. Next slide. I think the one thing that people like me to mention from this slide is the liquidity, because I think people get confused still about the listed ETF. So yes, the fund is listed on the stock exchange. When you see low liquidity in the listed stock, it doesn't mean that the funds are illiquid. It just means all that reflects is the demand and supply on any particular day for the fund. So trust me, the fund is extremely liquid, and it has to be, otherwise people jump down my throat from everyone from the board down. It's probably the most important issue at the investment committee and at the board level for our funds is liquidity. And it's very tight. So you'll never see more than a few small caps in there, because I'm just not allowed to hold them.
There's a really good question here, I think, Nathan, that sums up what a lot of people do ask, and it's from John, and thank you for the questions too. Talking about the average discount to the net asset value. Now, this is something that's it's asked quite a lot, because as Nathan sort of touched on, the other thing that we do is we have a liquidity provider. So if you were to go to your shared trading account like CommSec, you'd actually, when you bring up INIF or any of the other 3 ETFs that we offer, you'd actually see on the buy-sell ticket 100,000 units at the buy price and 100,000 at the sell price. And that's the liquidity provider at work. So they're actually creating units, redeeming, and their job is to actually keep it 1 cent either side of the net asset value. So it doesn't trade at a premium or trade at a discount. When you buy, you're just paying 1 cent above, 1 cent below to sell.
I think the main point is that people confuse this and think it's a listed investment company, and they're looking to buy this at a discount, and then hopefully it trades at a premium at some stage. But it's been interesting recently. There's some other funds that have shirked launching a listed ETF vehicle, and they've stuck with their LICs. But anytime the market goes through a down period, and although it hasn't actually really been a down period recently, a lot of LICs at the moment are trading at massive discounts. And there are people in the market like Jeff Wilson who are looking to clean them up and take them over. And so The weakness of that LIC structure is coming to the fore again, as it does with every market cycle. And so this to us is the superior option, where you're buying a ready-made portfolio in an instant, and you can sell it just as quickly if you need the money for some reason.
That's right. And a lot of people are asking us with this secondary offer, what are the benefits? And we do have a lot of these questions answered in the Help Center. But to quickly just tell you now, when you come directly through this offer, you don't pay brokerage. So that's one of the biggest benefits. Plus, you'll get the units issued directly at the NAV, and that happens on the closing date. So the Friday, the 25th of August at 5 p.m. Sydney, Melbourne time. So you don't pay that spread, that 1 cent either side. Do you want me to jump to the next slide there, Nathan?
Hopefully that's the end of it. I'm sure people have heard enough of my voice.
Yeah, I guess this is the only the last one that if you are actually interested in taking up the secondary offer, you can go to the intelligentinvestor.com.au/INIF-offer. There's a QR code there too, so you can take a photograph of it and it will take you to that website. What I'll do now then, Nathan, if you like, we can take some questions. I'll give you a chance to get your voice back. I'll actually just show people where they can go in order to do this, and just some, I guess, admin and housekeeping, but definitely put the questions in. I've got a couple there I'll get back to for Nathan. So I'm just going to show my screen. So basically, what we're on the offer page, and the offer pages are set up whenever an offer comes around. And at the very top there, if you've got questions, you can actually schedule a call with the team. So find a time that suits you and we can talk to you and answer any questions. A lot of the questions are in the Help Center at the top right. There's also at the bottom right a live chat feature, so you can answer to us about this as well. But basically, as you go down, here are the important areas. The code, like we mentioned, is INIF, so it does trade on the ASX. Closing date is the Friday, 25th of August, 2023. So at 5 p.m. On that day, Sydney, Melbourne time, that's the cutoff. So if you do apply, which is just done by clicking on the Apply Here buttons, and it's all done online, it'll take you through the process. You'll get a BPay biller code and reference number to make the funds transfer, and that's important. Try and do that as soon as you can. Don't leave it to the last hour before the cutoff finishes, because sometimes banks have different sizes that you can send. So it's always best to do it as soon as possible. And if you send more than you've originally told us, that's not a problem. We'll allocate units based on the amount that you'll send. The other important dates there is the allotment date, the 31st. Then the listing date is the 1st of September. Minimum amounts $2,000. The management fees are 0.97% per annum. There's no performance fee for this ETF. But also here, the product disclosure statement, definitely read that. It's very important. The fund fact sheet and the target market determination goes into more detail to see if this is suitable for you. So definitely read that as well. And for those wondering, what will be the unit price that I end up with? It's written here just saying that units are issued at the net asset value. So that's the actual dead set middle, not the buy or sell price. And that's calculated at the close on the closing date, which is the 25th of August, 2023. And that's rounded down to the nearest whole unit. There's a lot more information on this page as well, obviously, talking about the breakdowns. Talking about the top holdings as of 31st of July, remember that we report to the ASX. So you can actually go to the ASX website, type in the ticker code INIF, and you can actually see the holdings and other reports that Nathan and his team put to the ASX as they're required to. There's some articles down the bottom here talking about different advantages of the dividend growth, etc. Who's on the team? And obviously some FAQs there, but more in the Help Center. I'll just jump back now to the actual slides, just so as we can. So hopefully that rounds a lot of it off. So I'll just go through and grab some questions here, Nathan. There was a good one from Vidana just before, and I know Vidana tunes in quite a lot with our webinars. Just asking, with the Star Entertainment, you know, are you looking to hold on to that? And I know there's like 9% cash in the portfolio, but I know you just don't go out there and buy whatever takes your fancy. There's a very considered process. But are there any new purchases on the horizon?
Yeah, so Star is a smaller position than what it was for obvious reasons, but there's a clear plan for this business to be worth materially more than what it currently is. So there's a few steps it needs to make. Obviously, the one thing it needs to get going is the new Brisbane casino, which opens next year. So that'll be great for the cash flows of the business, because that's just been in development now for a number of years. So that's important. Needs a final step to straighten out its balance sheet, and it's currently going through that process at the moment. There was a sort of good news from the on its taxes moving forward over the next sort of decade, where they're basically going to get a bit of relief over the next few years at least from those higher gaming taxes. So that was good news, although it ultimately has to increase them over time. But at least that gives what this company really needs at the moment is just a bit of time to get the Brisbane casino going. There's talk it may sell its other Queensland casinos just to help prop up the balance sheet, because we don't know what the size of the fines are going to be yet. But the value is obvious if it can get through, but it is a much smaller position than what it was. In terms of any new purchases, so just for anyone who doesn't understand, the cash that we get from this raising goes into the fund, and it doesn't just we don't just leave it there sitting there in cash, adding to the cash pile in the fund. We just invest it just like the existing fund already. So that's what we do with the money. In terms of, we're down to 9% cash, and that's really two ideas at best, or maybe just beefing up some of our other positions. So there haven't really been any new stocks. I was hoping this reporting season might throw up a couple of ideas, but it really hasn't. I think the only thing we've really done recently maybe is we've topped up CSL a bit. There really hasn't been too much else. So for people who like low turnover, this fund is definitely it. We've hardly done anything over the last 2 or 3 years because we like the stocks we own, and there really hasn't been any sort of great income ideas out there. I mean, the market just hasn't fallen in a heap like a lot of people predicted. So there hasn't been sort of a mass buying opportunity. I was going to say something else about the distribution from the fund was massive in last year, and it was quite sizable again this year. So just to make the point to people that we have to pay out all our capital gains that we've cashed in with stocks we've sold, which was a lot a couple of years ago. We had a bunch of takeovers. So really what you just want to stay focused on is the actual underlying yield of the fund coming from our companies. And then occasionally we will have capital gains from our stocks. But the big one this year was basically Whitehaven Coal, which I can't remember what we originally paid for. It might have been as low as $1 or some of them, and went to $11 at one point. But I think the sales were at $8 or $9. So we got massive dividends from that, but some big capital gains as well that we had to pay out.
There's a question here from Ash as well, and it's a very good question, and it's one that I can handle because it's more of the admin side. But can I invest in a corporate trustee name for my self-managed super fund? Yes, you can. During the application process, you'll actually be asked if you've got a share trading account in the name of that entity, and that's the quickest way to get the units sent to you for this offer. It's a holder identification number. So any entity, whether it's yourself as an individual, a joint, trusts, SMSFs, companies, as long as they've got a share trading account in that entity's name, you'll have a holder identification number. During the application process, choose that option, type that number in, the actual designation or name the account is in. And when we issue those units to you, they'll go directly to your share trading account. If you don't have a share trading account in that entity, it's not a problem. There's a little bit more to fill out during the process because we just need to find out who is the company, is the corporate trustee, etc. And we'll issue those to the share registry, which is a Link Market Services. And then down the track, if you decide to actually, set up a share trading account, you can transfer them by going through your share broker to the share broker's account. So hopefully that helps to answer. The other question here was from Agnes, just saying, wasn't there a growth fund, intelligent investor growth fund offer recently? And their answer is yes. We've got 4 ETFs now, Nathan, don't we? And we try and do at least one offer for each of them each year.
Yeah, so we do one every quarter, and the reason we do them is because one, I'd be doing a webinar to update people anyway, so we might as well take on the opportunity to invest in the fund. And not everybody has brokers, so some people like to invest directly through these offers. But in terms of our business, like, we need to raise money and grow our business. So the question is, how do you do it? And most people go out there and just chase financial planners, and it's very time consuming. And it's hard work, and it essentially takes me off the tools, because you're talking to people all the time, which means you're not focused on performance, because you simply can't do 2 things at once. So the way we've done it and works for us is we do these webinars. We offer the chance for people to tip more money in, but obviously you can tip money in whenever you like, just by buying units on the market whenever you feel like it. But the thing I like about this is, one, it gets us in front of everyone at least once a year. I know there's sort of the schedule's been a little bit around in terms of these offers recently, but we're trying to get into a set process over the next year where it's the same quarter for the same fund each year. It's just because we've had the new IISV, and we try not to put them on top of each other as well. And obviously there's other things happening in the business through InvestSMART, so we try not to lop all these offers on top of each other. So it's one offer per quarter. And I really like this because we get to front members, we get to answer questions. And if we don't perform, then no one's going to give us money. And that's how it should be. So I like this process, and it works really well because it means we can do it fairly efficiently, and I can stay focused on the returns of the funds, which is what matters. A lot of people in the business would like to be doing more media and things, but it's just a waste of time. It doesn't do anything for our business. I did all that for a decade, did nothing, doesn't raise any money. I know that from friends in the business who have the same roles as I do. And you spend all this time in the media and doing marketing, and it just doesn't do anything. But you deliver great returns. You get in front of people and you explain why you've earned them, and how you're going to perform in the future. If you stick to your process, then people can buy into that. So this process works really well for us. Yes, we want us to give you your money, but we want you to want to give it to us because we've earned it. We've earned the right. We've got no performance fees on most of our funds except the international fund, and we've got almost, I'd say, excellent performance across the funds of our performance. We've shown over 20 years we can do it. So as long as we keep doing that and we keep getting support, and then we keep doing the webinars, and the process works for everyone. And we obviously want to make investments in our business. We want to add more analysts. I'd like to reward team members better over time. So there's all these things we want for our business, but we can't do that unless we grow the business. And we're still a pint-sized fund managers. I mean, we've got about $300 million under management across 4 funds. So, and as long as they're fairly small, then we can, I'm more than confident in saying we can earn those outsized returns. But once you're managing billions of dollars, it just gets much harder. The best you can sort of hope for is maybe doing 1 or 1.5% better than the index. But as long as these funds are not managing billions, then we can shoot for 2% or 3 to 4% in our growth funds. So that's what keeps me motivated, and we get kept honest by doing this process.
And that's a very good point. And I think it's even a good way just to wedge in John's question here at the very end, because you're talking about wanting to keep it at a size where, it doesn't actually have too many negatives. Is there any planned caps for INIF in particular? Or?
Yeah, Ron and I talk about this sort of at least once a year in terms of what size would the funds have to get to before it starts to handicap our returns. And for the income fund, the level is a lot higher because the hurdle we have to jump is lower, in my view. For the growth fund, I think we should be aiming to do 2% outperformance a year and over. I think we can do that for the ethical fund as well, and also for the international fund, because they're not trying to produce a big yield as well. For INIF, but the bar is lower, because as long as we can do 1% over the index for an income fund, there really aren't many other funds. Like, you're in very, very unique company if you've got an outperforming income fund at all. So if you can do over 1%, you're in rare company. So, I still think we can do 2% with the funds the size they are, but when does it get to the point where maybe you couldn't even do 1%? Well, I think this fund could actually manage $1 or $2 billion in the Australian market, and we can still earn 1% or more. So the income fund's likely to be capped last, if you like, out of our funds, but we're so far away from that at the moment. I really feel like this income fund is the market's best kept secret, because I think if you asked any income investor whether they could outperform by 1 to 2% a year, plus get a bigger yield than the index, and a yield that's growing much faster, like I'm sure they'd all put up their hands and maybe put up two hands. But we're still a bit of a cult here at Intelligent Investor, and we're still growing, and that's what I like about it. This is the best position our business has been in, full stop, in its history, and it's just a great place to be around at the moment. And it's all because of the support of the people on this call, and and the silent investors who understand what we do, and we don't hear from them, but they keep giving us our money over time because they trust us, and that's what's most important. If you ever hear me getting on here talking a different story, or we've changed our process or something like that, then take your money out tomorrow. But for now, we've got a great team that's worked together for a long time, and I think our business can really be something, but we need to invest in it, and we need to grow the team.
I think it's a great way to finish off there, Nathan. Thank you so much, everyone, for joining us today. We've had so many questions that have come through. Remember, on the offer page, which the link is there, it'll have a help center. So a lot of the questions that are being asked actually are inside there as well, such as the benefits of going through this offer. It closes Friday, 25th of August at 5 p.m. Sydney, Melbourne time. So don't sort of hesitate there. Always, you can ask us questions. You can email invest@intelligentinvestor.com.au. Pick up the phone, use that schedule a call feature, use the live chat feature. But until next time, thank you so much for joining us. And again, thank you, Nathan, for so much of your insight into the income fund.
Thanks very much, Tom. And thank you, everyone, for listening. And hopefully next time I can relieve you of your duty on the slides.
Yeah, fingers crossed. We'll get that sorted. So yeah, thank you, everyone, for tolerating that. Great.
Thanks,
Have
mate.
a good time. See you. Bye.